we can find out contribution. Sorry. We can find out the contribution margin. So as its name implies, contribution margin, which means after covering fixed cost, whatever left will directly go to our net profit or net operating income. So whether the contribution margin is 80,000, 90,000, 100,000, after covering fixed costs, whatever left goes to net operating income. Even if we don't have this data, sales, variable expense, we don't have this data. We only have contribution margin and we have a fixed cost. We can easily say that. So that's why on the tips of the managers, if on the day-to-day operations, if they knew their fixed cost, so they can just ask the supervisor or their department, they call them, okay, how much is the fixed expense? 30,000. Okay, how much is the contribution margin? They find out, okay, 30,000. Okay, we are not making any profit in a matter of seconds. Rather, they make sales, cost of goods sold data. So on books, when we are doing this example, it looks very easy. But in real life, you need to collect data. How much is the sales? Total sales. Which branch? Which city? Which country? Right? You need to collect data. It takes months. So that's why you heard about from your friends or your parents or from your partners. Okay, these are the end days of the month. We need to report our quarterly earnings. We are busy. Closing is going on. So in that case, they are getting the data, calling everyone and accumulating the data. It looks very easy, but it takes time. So when you have contribution margin approach, it's very easy. Right? Let's move forward. So uses of contribution format, we can use the contribution margin approach for internal planning and decision making. For example, internal planning is going to be cost, volume, profit analysis, CVP analysis, budgeting, segment reporting, special decisions like pricing, make or buy decisions. It's like that. So we will discuss, we have a whole chapters on that and we will discuss about, but the format is going to be used as sale minus variable cost. We have contribution margin minus fixed cost. Answer is net operating income. So by the way, the question that should come to your mind is that, sir, why not we are explaining net income here? Why we are just focusing on net operating income here? Why don't we talk about tax? Why don't we talk about interest rate here? We didn't talk about the interest and taxes here, right? Since this accounting name is Managerial Accounting, right? We will, in our coming lecture, we'll talk about responsibility accounting over there. So managers are responsible up to the things they have control. So on interest rate, they have control. Interest rate set by the lender. You cannot decrease or increase the interest rate. So that is out of your hand. So we are not focusing interest rate. Can we control taxes? So that's why we excluded the effect of interest and taxes. So before we have EBIT, or the other name is EBIT, earning before interest and taxes, or the other name is net operating income. Net operating income, which means income of the business operation, selling and buying raw material. Right? This is called net operating income. So we are not taking into account the effect of taxes and interest, because we don't have any control over the interest and taxes. So that's why contribution margin approach is for managerial purposes. So let's just talk about this. Constructing an income statement. So last month, cyber games or computer games retailer had total sales of 1.45 million, selling expense to 10,000. Administrative expenses 180,000. The company had beginning merchandise inventory of 240,000, purchased additional merchandise inventory for 950,000, and had ending merchandise inventory for 170,000. You are requested to prepare income statement for the month. So this basically exercise, we don't have any fixed cost or any variable cost. So it means we will make our income statement based on traditional format. Traditional format, sales minus cost of goods sold minus is equal to gross profit minus selling and admin. Answer is, but here we need to find out the cost of goods sold. We are not given the cost of goods sold. How we can find out the cost of goods sold? Recall your accounting knowledge. Opening inventory plus purchases minus ending inventory is your cost of goods sold. Right? So let's jump directly into our answer here. So you see sales 1.45 billion minus cost of goods sold. How we can find out the cost of goods sold? Opening inventory plus purchases minus ending inventory. Answer is the cost of goods sold. So answer, sale minus cost of goods sold. Answer is gross margin. So we have a gross margin worth of 430,000 and less selling and admin. So selling and admin total 390,000. Answer is 40,000 net operating income. Right? So the question why I put it here is that because we are not given data in the form of fixed and variable cost, right? No other information. If you look at the question here, no information regarding, we know the nature of the administrative expenses, the merchandise inventory, additional merchandising inventory, ending merchandising inventory, but we don't know about the nature, the behavior of these merchandise inventory. We know that sales, okay, sales, we know variable cost, units increase or decrease, the variable cost increase or decrease, but we don't know the pattern here for fixed and variable, right, behavior. So that's why if the question is silent, then use your logic. Either we need to make a traditional income statement or either we have to make through contribution margin approach. So let's just go through that. Here we go. Now prepare a schedule of cost of goods manufactured. Cost of goods manufactured, not cost of goods for sale. So what is the formula for cost of goods manufactured? Use your accounting knowledge. Cost of goods manufactured in means total goods that are manufactured in the company, not sold, in company. So opening, so first of all, we have raw material plus we convert it into labor plus finished goods. This is a process to convert raw material into finished goods, right? But we know that manufacturing cost is equal to direct labor, direct material and manufacturing overhead, right? So we have given direct labor, right? 135,000. We have direct labor, we have direct material. Do we have direct material? We have beginning raw material, we have purchased raw material and ending raw material. How much is the cost of material that are used? Simple, opening plus purchases minus ending. So opening raw material 60,000 plus purchase of raw material 690,000 minus ending 450,000. Answer going to be that one. And then overhead is already given to us, right? So when you convert raw material into finished goods, there is work in progress. So it means semi-finished goods are also there. This is a trick here. So again, how much is the semi-finished goods? Opening semi-finished goods, which means beginning work in progress, plus purchase of work. We don't have the purchase of work in progress, and then minus ending. So you see, let me just give you the answer here. Here, manufacturing cost is equal to direct material, direct labor, and manufacturing overhead. So you see, direct material, we have raw material, beginning inventory plus purchases minus ending inventory. And then we have the direct labor and then manufacturing overhead. So total manufacturing cost is there, but they said that the cost of goods manufactured, at the end, what you have to do, just add beginning minus the closing one. That's it. In order to find out the cost of goods manufactured, remember that one, we just talk about the cost. Manufacturing cost is equal to direct labor, direct material, manufacturing overhead, right? That is the manufactured cost of goods manufactured, or manufacturing cost, right? Because we have, in a manufacturing facility, we do have which kind of inventory? There are three types of inventory. Number one is raw material. Number two is work in progress. Number three is finished goods. So the raw material is going to be accounted for in direct material. Work in progress and finished goods are accounted for after the manufacturing overhead. That's it. Because there is no purchases of work in progress, since our prime focus is to convert raw material into finished goods. So semi-finished goods